Welcome to Chapter 2, the overview of Canadian financial marketplace. What will you learn here? We're going to start off the chapter with the definition of capital. Then we're going to learn about the different types of financial instruments or securities, then continue learning different types of financial markets and financial intermediaries. We're going to finish up the chapter with talking about the regulatory framework of financial securities in Canada. This chapter starts on page 63 of your PDF textbook and ends on page 88, totaling of 25 pages. There is no math and formula. Oh my God, there is no math and formula. So relax. And the most important thing about this chapter is you're going to see 5 questions on your final test just from chapter 2. We're going to cover everything, ins and outs, in only 7 slides. So let's get to it. What is capital? Capital is wealth, whatever you own, your assets. These are called capital. It refers to all financial resources and assets owned by an individual or corporation or government. Okay? These assets can be both real, like a house, like a car, real things are tangible things. Okay? And the capital also can be representational, like money. These are intangible, like stocks, like bonds. These are intangible capital. Why we are reading about capital? Because capital is one of the most important factor in our daily life. We know that the chance of having a great life with capital, I know there are lots of factors involved for having a good life, but the chances are higher when you have more capital. And you, as a mutual sales rep, you need to understand different types of capital, real and tangible, and representational and intangible. Great. The only source of capital is savings. That's fair enough. But savings of who? Savings of individuals, corporations, government, and foreign investors and foreign residents. There is a point here. Non-financial corporations are not important providers of funds to others, to the society. But why? Because they keep their savings and they keep their money to expand their operation, to add a line to their production, to hire new people. They keep it for themselves. They don't spread it out to the society. So that's very important point to know that non-financial corporations are not important providers of capital to the society. There are 3 characteristics with capital. Capitals are sensitive, mobile, and scarce. What do we mean when we say capital is scarce? Capital is limited. People can't just generate money. Like governments can't do that because it will cause inflation. They can't just print money. That's not how economy works. That's why capital is scarce, limited. Capital is mobile. What does that part mean? When we say capital is mobile, we mean that capital loves the countries with stable political environment, with a stable financial policies and economic trends. Capital love it. So it goes from a bad environment, bad economy, bad political environment to a good one. That's why we say capital is mobile and capital is sensitive. What does that part mean? When we say capital is sensitive, we mean that capital is affected by the government policies, different monetary policies. So if interest rate goes up, it will affect capital. The capital in the society between individual will drop. They will save, do not spend their money. Okay, so capital is sensitive to all economic factors out there. There is a term called investment capital. What is investment capital? The portion of capital designated for investment activities is called investment capital. This investment can be direct investment. Like what? Like buying a house, buying a car, buying a business or machinery, or paying for a startup costs, or investing in a new highway by the government. These are all direct investments. Also, there are indirect investments, which are buying mutual funds, buying stocks, bonds, depositing your money. These are all indirect investment activities. So we need to differentiate between direct and indirect investment activities. Great, let's get to the first question of this chapter. Feel free to pause the video if you want to answer it first. Question: which of the following are not important providers of permanent funds to others in the capital market? A, government. B, individuals. C, non-financial corporations. And D, foreign investors. As we talked about it, non-financial corporations are not permanent providers of capital to the society because they save the money to expand their operation, to add a line, as we talked about it. Okay, they don't want to let it go to this society. They just control it themselves. So the right answer is C. Let's get to the next slide. Financial instruments or financial securities. What does financial securities or instruments mean? So you as a mutual fund sales rep, you need to deeply understand different types of financial securities or instruments, because you are going to invest your client's money in one of these securities. Okay, there are 4 different types of financial securities. First one is fixed income or debt securities. Second one is equity securities. Third one is investment funds. And the last one is others. So this others include every other securities that are not categorized in the first 3 types. What are fixed income or debt securities? Why they are called fixed income? Because these types of securities provide the investor with interest income. Okay? For example, I'm a corporation. I'm issuing a bond. Okay? I'm saying, hey, anybody who buys this bond, I want to give that person a 5%, for example, interest rate, or we're going to talk about this coupon rate. We're going to talk in details about this bond pricing, about these terms, but this is an example, okay? So fixed income or debt securities provide clients or investors with an interest. We have three types of fixed income securities, which are bonds, debentures, and money market securities. So basically, debentures, the difference between debentures and bonds are guaranteed, like most of the time. Bonds are secured with something, but debentures are not secured with something, you know. When the security is not secured, it means the default risk is high. So it is really highly like a risky investment. But here in Canada, only governments, which are secured corporations, only government issued debentures. So debentures are safe. The only difference is that. So there are three types of fixed income securities: bonds, debentures, and money market securities. Money market securities are those which has like a less than 1 year term. We're going to talk about term, maturity date in the future, but money market securities has less than 1 year term, which categorized to T-bills, commercial paper, and etc. The second type of financial instruments are equity securities. So what are those equity securities? By buying an equity security, you're owning a portion of that corporation. You're owning something. You're now shareholder. Okay. There are two types of equity securities, which are common shares and preferred shares. As I said before, we're gonna talk about these in details, the difference between common shares and preferred shares. But as a quick point, I can say that preferred shares, those who has preferred shares will get dividends. Those who has common shares will be their stock price will be appreciated, and they're going to gain from this price difference. So common shares are hoping for capital appreciation, and preferred shares are hoping for the dividends. The third type of financial instruments are investment funds. So investment funds basically combine all types of securities. There are two types of investment funds: closed-end funds and open-end funds, or mutual funds. We call open-end funds mutual funds. Okay? That mutual fund can be categorized into different types of mutual funds, more than like 7 or 8 type of mutual funds, but we just listed equity mutual funds and fixed income mutual funds, balanced mutual funds here, but we do have different types of mutual funds. And the last financial instruments named others. Others, as I said, includes every other than these three instruments, which are derivatives, ETFs, segregated funds, hedge funds, PPNs, and lots of other different types of funds. We're gonna learn this others in the ending chapters of this book, especially like all of them. Yeah, we're gonna learn all of them in the ending chapters. Great, awesome. now we learned the financial instruments, different types, the bird view of financial instruments. Let's get to the question. Don't forget to pause. Please answer it yourself first. Which type of financial instrument represents an ownership stake in a company and allows investors to participate in the company's fortunes? A. Debt securities. B. Equity securities. C. Investment funds. D. Derivatives. As we talked about it, the right answer is B. When you buy equity securities, you own something in that corporation. So you're shareholder in that corporation. Awesome. Let's get to the next slide. Financial market. This is also a very important topic in this chapter. What is financial market? Okay. Financial market is a place that these financial transactions happen. This is in simple terms. There are two types of financial markets: primary market and secondary market. What's the difference? In primary market, people, individuals, corporations trade new securities. The securities, new ones, like the ones who have just released, okay, initial public offering, IPOs, haven't been released before. What's the example of primary market? Mutual fund. Mutual funds are traded in primary market. Remember, you're going to be questioned. I feel like you're going to be questioned about this. The second type is secondary market. People trade already existing securities in this market. Okay, so that's the difference between primary and secondary market. Then that secondary market can be categorized into two different markets: auction market and dealer's market. What's auction market? Auction market is operated based on buyers' bid and sellers' ask. So buyers bid, sellers ask, they compete with each other, and whenever the bid and ask matches, the transaction happens. This is called auction market. Whoever offer a higher price will get the security sooner. What's dealer market? Dealer market, or over-the-counter market, is operated based on dealers' negotiation with each other. So there's no individual involved in this transactions. Dealers negotiate with each other, okay, to find a fair price. Stocks are bought and sold in auction market. So the example for auction market is stocks, and the example for dealer's market or over-the-counter market is bonds and debentures. Great. So there is a term called liquid market. What is liquid market? Liquid market is a market that you can sell your security very fast. You don't want to wait, I don't know, a day, a week, or a month to sell your security. So liquid market has three characteristics, which are frequent sales. Lots of sales happen in a day, okay? You don't need to wait, it's instant. Narrow price spread, so bid and ask prices are the difference between these two are very low, narrow price spreads, and small price fluctuations. So your stock's value will not drop suddenly or will not rise suddenly. These are liquid markets. You can trust that market. Okay, awesome. Let's get to the question. Feel free to pause the video. If a large company wants to obtain funds to expand its operations, what market would it use to conduct the transaction? A, primary market. B, secondary market. C, auction market. D, dealer's market. Okay. As we talked about it, initial public offering, the securities that haven't been out yet. Okay, this is the first time a security goes out. Okay, these are dealt in primary market. So if a large company wants to obtain funds, they need to issue some bonds or they need to issue some securities. For the first time, they do it in a primary market. Great. Let's get to the next slide. Financial intermediaries. What are financial intermediaries? In simple words, these are places that act as a middleman between savers and borrowers. So financial intermediaries are middlemen. We have two types. One are deposit-taking financial intermediaries, like banks, credit unions, trust companies. These are deposit-taking financial intermediaries. And the second type is non-deposit-taking. Like what? Like insurance companies, like investment dealers, mutual fund dealers, and pension funds. These are non-deposit-taking financial intermediaries. We need to know there are two dealers: investment dealers and mutual fund dealers. Okay, we're gonna see these two terms a lot in the book. So let's have a look in details. What's the difference between investment dealer and mutual fund dealers? Investment dealers are financial intermediaries that provide services like investment advice, executing trades, different type of securities like stocks, bonds, ETFs, mutual funds. So executing trades on behalf of the clients in secondary market. We're going to talk about the secondary market in the future slides. Underwriting new securities in primary market. Underwriting means taking care of all paperwork to issue a new security, new stock, new bond to the society. And facilitating mergers and acquisition. So the examples of investment dealers nowadays, JP Morgan company is an investment dealer, Wealthsimple is an investment dealer, and Morgan Stanley, the company called the famous Morgan Stanley, these are all investment dealers. On the other hand, mutual fund dealers are financial intermediary that provide services like buying and selling only mutual funds. Okay, I'm going to emphasize on that. Mutual fund dealers provide services like buying and selling just mutual funds. Providing another activities of mutual fund dealers are providing advice on selecting a mutual fund, The examples, the real company examples are Fidelity Investments, Vanguard Group, and BlackRock Groups. These are all mutual fund dealers who are expertise in the mutual fund industry, just mutual funds, not an individual stocks or individual bonds. Great. We've learned the financial intermediaries and different types and the difference between investment dealer and mutual fund dealer. Let's get to the question. Which financial intermediary takes deposits from individuals or corporations and invest those funds? A, stock exchanges. B, insurance companies. C, investment dealers. And D, trust companies. As we talked about it, the right answer is D, trust companies. Banks, credit unions, and trust companies are deposit-taking financial intermediary. Awesome. Let's get to the next slide. Canadian Securities Regulatory Framework. One of the most important slides of I think all the chapters, because we're gonna get some questions from this regulatory framework. The first body that we're gonna talk, by body I mean BODY, regulatory body, we're gonna talk is Provincial Securities Commissions. Provincial Securities Commission. They launched on 1934. Okay, what do? Like each province in Canada has their own provincial securities commissions. They review and approve the new securities that are going to go to the market and maintain market integrity. So the duties are this. And then they also review and approve the rules and initiatives proposed by SROs, self-regulatory organizations. I'm going to talk about this SRO, okay, in this slide. They also conduct periodic assessment of their operations and intervene when necessary to protect the investors. Unfortunately, you need to know all the duties mentioned here for the Provincial Securities Commissions, because you're going to be questioned about this. So, then, in 1936, these Provincial Securities Commission, they gathered together, okay, to align the rules. They have established a regulatory body called Canadian Securities Administrator. Okay, so that famous CSA that we had in chapter 1, this is it. So CSA is originated from Provincial Securities Commission. What do CSA do? CSA created for consistency and coordination purposes between provinces. Okay? Coordinate securities regulation. The duties are coordinate securities regulation, develop policies and harmonized rules along different provinces, enhance investor protection, promote fair and efficient capital markets across Canada. These are duties of CSA. And again, unfortunately, you need to learn it. You need to kind of memorize it. But you get the whole framework structure. We had the Provincial Securities Commission first, and then they gathered together and established CSA. Then, in 1998, a new regulatory body evolved. The name is MFDA, or Mutual Fund Dealers Association. Oh my God, association. Okay. MFDA is self-regulatory organization, or SRO. What does that mean? MFDA created because mutual fund industry needed specialized entity. Okay, needed a specialized organization to focus on just mutual funds. MFDA regulates mutual fund dealers, just mutual fund dealers, not investment dealers. We talked about the difference between investment dealer and mutual fund dealer. Remember in the previous slides? So, MFDA regulates mutual fund dealers and their registered employees. Also, MFDA established standards of conduct, oversee compliance, protect investors in the distribution and sale of the mutual funds. These are the rules of MFDA. And finally, in 2008, IIROC, another SRO, has been created. IIROC created because some corporations are beyond just mutual fund dealer. Okay? They are investment dealers. So, IIROC regulates investment dealers and their registered employees, set industry rules, and supervise compliance, protect investors in the trading of securities and related activities. Awesome. This slide, as I said, is regulatory framework of Canadian securities. Unfortunately, we need to learn duties of all these four bodies, BODIES, not BUDT. You can look them as a body if that helps. But yeah, we need to memorize all the rules, all the duties of this four regulatory bodies. Let's get to the question. What type of question you may face about this specific topic? Question: which entity holds the ultimate responsibility for regulating mutual funds in Canada? Provincial Securities Commission? B. Financial Action Task Force? C. Canadian Securities Administrator, or CSA? And D. Federal Government of Canada. I think you may get this question, this exact question in your final test, because I've seen in my test. So, about option D, federal government has nothing to do with securities in Canada. So forget about it. Option B, Financial Action Task Force, FATF, do something else. We haven't talked about FATF yet in this course. So forget about that. FATF relates to money laundering and does not have ultimate responsibility for regulating mutual funds. Okay, there is option A and C. CSA, remember, CSA is just doing the aligning thing. Coordinator. CSA acts as a coordinator. Okay. Provincial Securities Commission has the ultimate goal ultimate responsibility for regulating mutual funds. Okay, CSA just coordinates these provinces, align the rules. So the right answer is A. Feel free to read the text, like that white text in the right side, to see what book says about this question, because these questions are extracted directly from book. Awesome. Let's get to the next question. Next slide, sorry. Okay, I do have a challenge for you. Let's solve it. Feel free to pause the video, read the question and options, have the right answer in your mind, and then continue the video with me. I mean, we're gonna solve it together. Question: the Thompson family allocates a significant portion of their earnings towards their retirement savings. Okay. Previously, they maintained their savings in a bank account, but recently they made a strategic decision to diversify their investments. They chose to invest in the common shares of XYZ Corporation. XYZ Corporation utilizes a portion of their investments to acquire new technology equipment, while another portion is invested in renewable energy projects. Which direct investment can be identified in this sequence of events? This is really great question. This is really great question. It's about direct investment and indirect investment. Remember, indirect investment, we're buying stocks, bonds, depositing or saving. These are all indirect investment. And direct investment, we're buying house, land, car. Yeah. Let's get to the options. Option A, XYZ Corporation's investment in renewable energy projects. B, XYZ Corporation's purchase of new machinery. C, the Thompson family depositing their money in a bank account. D, the Thompson family depositing their money in a bank. D, the Thompson family's investment in common shares of XYZ Corporation. As we talked about, the C and D are indirect investments. And the question is looking for direct investment. We're down to option A and B. Actually, I think both option A and B are correct, because option B says XYZ Corporation's purchasing a new machinery. So this is definitely a direct investment. Option A also says XYZ Corporation's investment in renewable energy projects. So this is also new projects. Yeah, this is also correct. So A and B both are correct. And this is weird. I'm sorry for this question. But it's cool. It's cool to know that A and B, because these are both direct investments. But B is more correct, more accurate. Great. Let's get to the next question. This is an individual challenge designed for you. Okay, let's get to it. Just please answer it yourself first. We're going to make sure that you are getting all the information. You are acquiring everything. In OTC market, over the counter or dealer market, in OTC markets, who is responsible for entering the bid and ask quotations? A. Dealers. B. Buyers and sellers. C. Security issuers. D. Banks. The answer is option A. Why? As we talked about it, in OTC or dealer market, dealers negotiate with each other and find a fair price. There is no individual buyer and seller. Instead, in the auction market, buyers bid and sellers ask operates in the auction market. Awesome. That was it. Yeah, we did it. This is end of chapter 2. I think you're doing great. Like, you're absorbing all the required information, and I can feel the confidence because you're building a good foundation of this course. Awesome. You did a great job, and I'm gonna see you in the next chapter, chapter 3. So take care of yourself.